my name is Singru and today I will explain about the question 1. The question is to determine whether it is concerned with short run or long run production decision, and it has different case. For the short run means that to produce more output, the firm has to employ more labor, which means that increase its cost, and it still has one of the input is fixed. However, for the long run decision, all the input are variable and all the costs are variable. In case A, it is stated that the global operation chief executive at Adidas wished to acquire Gladfoot in order to expand the company's sports shoe line to include specialty shoes. So, the answer is long run production decision, because the period is long enough for the global operations chief executive to expand their production line, which their input are all variable. The question B is said that the vice president of Walmart decided not to build another distribution center in Virginia, instead choosing to extend hours of operation by 7% at each one of the 14 distribution centers in the greater Richmond, Virginia area. The answer for me is short run production decision, because at the condition of plant, which mean by the number of distribution center is fixed. The vice president just varies its output by increasing the hours of operation at each of the 14 distribution center. This means that it still have the fixed input. The question 6 is about the Gemcon Direct, a diamond brokerage firm in Beirut, lays off 5 of its brokers in response to declining demands for its services. My answer is it was short-run production decision, because the diamond brokerage laid off 5 brokers in order to respond to declining demand for its services in the short run. This means that there was still the fixed input or the fixed cost exist. Question D is state about Tampa International Airport announced that it will add a 5th concourse in order to meet the growing demand for air travel in West Central Florida. This for my answer is long run production decision. It is because increase in the concourse represent the increase in long run input that is fixed in size in the short run.
Question 2. Suppose your business is currently employing 750 workers. The only variable input at a wage rate of Rm48. The average product of labor is 96. The last worker added 6 units to total output, and total fixed cost is 12,000 ringgit.
A. What is marginal cost? Marginal cost represents the incremental cost incurred when producing additional units of goods or service. It is calculated by taking the total change in the cost of producing more goods and dividing that by the change in the number of goods produced. The marginal cost formula can be used in financial modeling to optimize the generation of cash flow. The formula of marginal cost is change in cost divided by change in quantity. So, MC equals to 36,000 ringgit minus 35,952 ringgit divided by 72,000 units minus 71,904 units, which you will get 50 cents.
B. What is average variable cost? The average variable cost represents the total variable cost per unit, including materials and labor, in short-term production calculated by dividing total variable cost by total output. A change in output causes a change in the variable cost. For the formula, average variable cost is total variable cost divided by the quantity, which is 36,000 ringgit divided by 72,000 units, and we get 50 cents.
C. How much output is being produced? Output equals to level of labor times average product of labor, where you will get 750 times 96, which is 72,000 units.
What is average total cost? The formula of average total cost is very simple and it is calculated by dividing the total cost of production by the number of goods produced. The formula for average total cost is cost of production divided by quantity of units produced. Total cost divided by quantity, which is total fixed cost plus total variable cost. We get 48,000 ringgit divided by 72 units of output, which is 67 cents.
E. Is average variable cost increasing, constant, or decreasing? What about average total cost? Based on the graph on the right, we can see that the average variable cost, AVC, is increasing because MC will exceed AVC after cutting through the minimum point of AVC, while average total cost, ATC, is decreasing as ATC 0.67 is larger than MC, which is 0.5. MC does not exceed ATC, which causes ATC to show a downward curving graph.
My name is Chija Hui and I will present question 3. For question 3, Ali Salon hires you to determine the company's status. The data in the above table provides information on the company's actual annual costs and revenues. Ali spends at least 40 hours a week at her place of business. If he closed the salon, he could work for her competitor and earn Rm 15,000 per year. He also owns the building that houses the salon and could rent it out for Rm 18,000 per year if he closed his business. And for question A, calculate the economic cost and economic profit for Ali Salon. For B, would an accountant come to the same conclusion about the profitability of this firm? Explain. So let's look about the answer for question 3A. Calculate the economic cost and the economic profit for Ali Salon. So before we find the economic profit, we must find the economic cost first. Okay, so how are we going to find the economic cost? Is basically using the formula, which is implicit cost plus implicit cost. Explicit cost is basically the payment to non-owners for resource they supply. So from the questions, we know that the explicit cost is the wages, which is 25,000 ringgit, and interest paid on loan 3,000 ringgit, and the other expenditure for input, which is 31,000. So by adding it up, wages, interest, and the other expenditure, we will get the answer 59,000 ringgit. And after that, we will find the implicit cost. Implicit cost is the opportunity cost. So if Ali chooses to continue his business, the opportunity cost will be the salary Ali received from the competitor and the rental received when he rent the building. If so, the salary is 15,000 ringgit and the rental is 18,000 ringgit. So by adding it up, we will get 33,000. So explicit cost is 59,000 and the implicit cost is 33,000. By adding it up, we will get 92,000, and this is the final answer for the economic cost. After we have find the economic cost, we can proceed to compute the economic profit. To find the economic profit, we will have two formula. The first one is account profit minus implicit cost, and the second one is total revenue minus economic cost. For this question, we will be using the second formula, which is total revenue minus economic cost, since we already find the answer for economic cost. So the total revenue for this question is 90,000 based on the table, and the economic cost is 92,000. So by using total revenue 90,000 minus economic cost 92,000, we will get the answer economic loss 2,000 ringgit. As for the question B, would an accountant come to the same conclusion about the profitability of this firm and explain? My answer is no. Accountant will not come to the same conclusion about the profitability of this firm, as Ali Saloon is using the economic profit. Economists and accountants view profit differently, largely because they view cost differently. Economists and accountants apply different kinds of costs to the same production or service revenue, resulting in economic and accounting profit. So from here we know that economist is using the economic profit and the accountant is using the accounting profit. The major difference between these two profit is accounting profit is not taking the implicit cost, while the economic profit is taking in both costs, which is explicit cost and implicit cost. So if the accounting profit is not taking the implicit cost, the accounting profit will be relatively larger than the economic profit. So the concept of economic profit is most useful in making business decisions than consider opportunity cost. On the other hand, the concept of accounting profit is very beneficial in making management decisions than generally focus on direct costs only. Thank you.
Question 4. Complete the following table and then round each answer to the nearest whole number. So first thing, I would like to find the fixed cost with the information given at output 4, which is the total cost is 105 and its average fixed cost is 10. So I'll use the formula of average fixed cost equal to fixed cost over quantity, which is 4 multiplied by 10, and I will get 40 for the fixed cost. Next, to find the variable cost, we need to minus the total cost with the fixed cost, and then we will get 65 for the output 4. And then for the marginal cost is the change in the total cost divided by the change in the quantity, and we will get 25. And then the average cost is the total cost divided by quantity, which you will get 26, and the average variable cost 16. And then for the output 0, the variable cost remain 0 and the fixed cost is 40, because fixed cost is incurred at all levels of output including 0, so the total cost will be 40. And next, for the output 1, the marginal cost stated here is 5, and it is because of the 45 minus with the total cost 45 minus with 40, and we'll get marginal cost 5. And then the variable cost is 5, the fixed cost is 40, the average cost is 45, and the average variable cost is 5, and then average fixed cost is 40. Next, for the output 2, the variable cost is 20 and the fixed cost is 40, and the total cost will be 60. And the marginal cost, the difference between the total cost with the previous output is 15, and their average cost is 30, the average variable cost is 10, and the average fixed cost is 20. Next, for the output 3, the variable cost is 40 and the fixed cost is 40, and then the total cost will be 18 and the marginal cost is 20. The average cost is the total cost divided by the quantity. So the total cost is 80 divided by 3, we'll get 26.6 something, and then after round off we'll get 27. and then the average variable cost stated there is 13, and average fixed cost is the total fixed cost over quantity. 40 divided by 3, and then you will get, after rounding off, you will get 13. And then at the output 5, the total cost is 150, and the variable cost stated is 110, and then we will get fixed cost as 40. The marginal cost is 45, the average cost is 30, and the average variable cost is 22. The average fixed cost is 8. So the last one output for output C, or the quantity for 6, the variable cost is 160 and the fixed cost is 40. So the total cost will be 200, and then the fixed cost will remain 40. And then the marginal cost is the change in the total cost and divide by the change in the quantity. So meaning that 200 minus 150, you will get 50 there. And then the average cost is, when you total cost divide by quantity, you will get 33. And then the average variable cost, you will get 27. And then the average fixed cost, you will get 7. Yeah.
Question A, calculate the accounting profit for the new business. So basically, accounting profit equal to total revenue minus total expense, which is explicit cost. So total revenue equal to 1.5 million and total expense equal to 1.1 million, which is include rent, supplies, and employees' salaries. So accounting profit equal to 400,000. Question B, calculate the economic profit. So basically, the economic profit is equal to total revenue minus total expense, which is include explicit cost and implicit cost. We can also calculate the economic profit using accounting profit and minus implicit cost. So accounting profit is 400,000 and the implicit cost is totally 135,000. So we can calculate that economic profit is 265,000. The implicit cost is included the salary earned if Debbie worked as a scientist, entrepreneurial income, and the interest of saving.
For question 6, the question is, the total cost in the short run is shown below. TC equals to RK plus WL, where R is the fixed interest rate and K is the amount of fixed capital. The W is the fixed wage rate and L is the amount of labor. Based on the above equation, derive the relationship between A, average variable cost and average product of labor, B, marginal cost and marginal product. For part A, the relationship of average variable cost and average product of labor. AVC is the variable cost per unit output, where AVC is equivalent to WL over Q. The AVC curve plots the short-run average variable cost against the level of output and is typically drawn as U-shaped. Average total cost, ATC, is total cost per unit of output, which is derived as ATC over Q is equal to AFC over Q plus AVC over Q. ATC is equivalent to RK over Q plus WL over Q, which is equivalent to the product of R and R over A plus the product of W and W over A, where AR equals to Q over K is the average product of capital and AW is equal to Q over L is the average product of labor. Average fixed cost continuously falls as production increases in the short run because K is fixed in the short run. The shape of the average variable cost curve is directly determined by increasing and then diminishing marginal returns to the variable input. For part B, the relationship of marginal cost and marginal product. MC is at minimum at the same output level at which MP is at maximum. When MP is rising, MC is falling. MC equals to TC over Q, which is equivalent to TVC over Q. AVC is at its minimum at the same output level at which AP is at its maximum. When AP is rising, AVC is falling. An increase in a variable cost shifts the total cost, TC, average total cost, ATC, and marginal cost, MC, curve upwards.